You know, something fundamentally broke in South Korea's chemical industry in 2025. And I'm not talking about just a bad quarter. So, our deep dive into the 2025 annual reports, based on HDIN research, it reveals a story that's not just about numbers. It's a story of survival and a total radical transformation.
The change we saw in 2025, well, it wasn't some temporary dip. It was a permanent earthquake that completely redrew the market map. For an industry that has long been a pillar of the Korean economy, this is a code red moment. And at the very heart of this seismic shift, well, it all comes down to one single game-changing factor.
You see, for decades, the formula was super simple. South Korea produced basic commodity chemicals, and China bought them up. It was a reliable, profitable relationship. But now, as this slide makes incredibly clear, China has totally flipped the script. After a colossal build-out of its own factories, it's no longer the biggest buyer, it's now the biggest competitor, and it's flooding the world with supply, absolutely crushing prices for everyone else. So, what does a supply glut actually mean for these companies? Well, it translates into a direct and absolutely brutal squeeze on their bottom line. We're talking about a structural crisis in profitability, and it starts with a concept every single investor really needs to understand. Okay, so it's called margin compression. Let's break it down. Imagine you own a bakery. Suddenly, the cost of your flour skyrockets. But at the same time, a new, massive bakery just opened up across the street, and they're selling bread for super cheap. You just can't raise your prices without losing all your customers. Your profit, your margin, gets squeezed to almost nothing. That, right there, is exactly what's happening to producers of basic chemicals right now.
So what does this look like out in the real world? Well, we're seeing a massive oversupply in basic plastics like polyethylene and polypropylene. The price spreads, they're at rock bottom, historic lows. And to make matters worse, demand from key sectors like construction and electronics is weak. But, and this is where it gets really interesting, while the basic market is in a free fall, high-value materials for things like cars and computer chips are holding up. And it's this divide that really tells the whole story.
All this intense market pressure has basically split the industry right down the middle, creating two completely different realities. On one side, you've got the giants who built their empires on those commodity chemicals, and let me tell you, they are in deep, deep trouble. On the other side, you have the specialty champions who are navigating this crisis with remarkable strength.
Yeah, this slide perfectly contrasts these two realities. On the left, you've got Lotte Chemical, a giant that's heavily exposed to those commodity markets we just talked about. And the result? Staggering losses. Then, on the right, you have Kumho Petrochem, which is deliberately focused on high-value specialty products. And it's not just surviving, folks, it's thriving with a rock-solid balance sheet. Just look at this number. Over $1.7 billion US dollars. That's the net loss Lotte Chemical reported in 2025 alone. This isn't just a cyclical dip. This is a five-alarm fire that is forcing the company to literally write down the value of its own factories because they simply can't compete anymore.
Okay, now contrast that with Kumho Petrochem, operating in the exact same market environment. A debt ratio of just 36.4%. And you know, this isn't just a number, it's a financial fortress. It shows stability and the power to withstand the storm, and it's a direct result of its strategic focus on niche, high-value products.
But, you know, the danger signs aren't always where you'd expect to see them, like on the income statement. There's this hidden red flag that every analyst looks for. It's a situation where a company looks like it's growing on the surface, but underneath, it's actually running out of air. And SK Innovation is a perfect textbook case of what we call bleeding growth. Its battery division, SK On, is posting these huge revenue numbers as new plants come online. But if you look deeper, its joint venture took a massive $3.15 billion loss. And the crucial point is right here. Its operating cash flow is negative. It's literally burning through cash just to run its daily business and has to borrow money just to stay afloat. It's a high-stakes gamble that could pay off big or, well, end in disaster.
So faced with this kind of existential crisis, the industry isn't just sitting back and watching. No way. It's responding with one of the most ambitious strategic pivots we have ever seen. This is a multi-billion-dollar bet to completely remake itself for a new era. And this transformation, it follows a really clear two-step logic, which you can see right here. First up, the great asset retreat. Companies are aggressively selling off their old, low-margin, carbon-intensive commodity businesses. Then comes step two, the green tech gambit. They're taking that cash and plowing it right back into the future, battery materials, hydrogen, and other sustainable, high-growth technologies.
And the scale of this bet? It's just staggering. I mean, we are not talking about pocket change here. LG Chem is deploying nearly $9.4 billion in capital expenditures. That's money they're spending on huge new factories and equipment, and it's heavily focused on battery materials. S-Oil is investing over $6.5 billion to bypass fuels entirely and convert crude oil directly into high-value chemicals. This is an all-in offensive move.
Hanwha Solutions gives us a perfect window into this strategy in action. See, they're not just investing in green tech. They're trying to build an entire ecosystem around it. They're getting out of old businesses and going all in on things like next-generation solar cells, developing technology for the future hydrogen economy, and cementing their global leadership in advanced materials. It's a complete strategic reorientation.
All right, so after all this upheaval, how should we be assessing these companies as we head into 2026? From an analyst point of view, the old ways of looking at them are just obsolete. We need a new framework, one that separates genuine resilience from all the hidden risk.
So here's the bottom line. The dividing line is crystal clear. On one side, you have the hallmarks of resilience: low debt, a real protective moat in niche technology, and a focus on high-value products that leads to financial stability. And on the other side, all the red flags of risk: high debt, heavy exposure to crowded commodity markets, and that dangerous negative cash flow we saw earlier. This, right here, is the new checklist for the K-chemical landscape.
And that leaves us with the ultimate question, doesn't it? The industry has, correctly, identified the crisis and is making an audacious, multi-billion-dollar bet on a green, high-tech future. But in a world of fierce global competition and rapid technological change, the big question remains: will this massive pivot actually be enough to secure its future?